Richard, what happens when a company goes into liquidation? What happens to employees who are owed wages, holiday pay, redundancy pay and pay in lieu of notice?
Yes, well, one of the first things that a liquidator does is process the employee claims, and the employees can actually claim for redundancy depending on how long they've worked for the company, and that's up to £400 a week they can claim. There's also pay in lieu of notice where they can claim for up to 12 weeks pay in lieu of notice, so that's 1 week's pay for each year's service. There's also arrears of pay they can claim for up to 8 weeks, and holiday pay, the balance of their holiday entitlement, they can also claim that.
And where does that money actually come from if the company's in liquidation?
That comes from the Insolvency Service, which is part of the Department of Business, Industry and Skills, and that normally gets paid between 3 and 6 weeks after the company's gone into liquidation.
Richard, when you're appointed as a liquidator or administrator, who sells the assets, and can directors buy the assets back?
Yes, well, on this one, the liquidator has a duty to sell the assets for the best price possible. In some cases, we have to sell plant equipment and other assets, cars, through an agent, where when the company's closed down and the directors hasn't got any interest in the assets at all. But on occasions, the director is the person that's really knows the value of the assets, and if he wants to carry on trading or set up a new business, he could do so, and he's probably the best person to buy the assets. And in that case, we would take our agent's advice as to what offer was acceptable, and as long as that director's offer is above that, we'll go along with the director, and he'll pay us the money from his own personal resources, and he can set up another business and do that, as long as really he hasn't been doing this over and over and over again, in which case we'd be a bit more wary about that.
What will the bank do when they hear about a company going into liquidation?
Well, the bank will automatically freeze the company's accounts. The liquidator will write to them and will be asking the bank about the movements on the account and various other details, including if they've got a debenture. The bank will write to the liquidator and ask if there's going to be any realisations from the assets about their recovery. And if they haven't got a charge over the assets, there could well be some realisations paid to the bank as a result of that, but probably several months after the commencement of the liquidation.
In terms of liabilities, can creditors recover stock that they've supplied?
Well, this depends on the terms and conditions that they've given to the company. They could claim retention of title, and it then depends if those terms are a simple clause or an all monies clause. So they've really got to either identify the goods that may be on the premises, or they've got to prove that they've got their clauses are incorporated into the terms of trading, and that's something that a liquidator looks at. And if there is stock there and the conditions are met, yes, they can take the stock back.
What should a company do if HMRC are threatening to take walking possession over a company's assets?
Well, this is really where the directors need to take advice very quickly, otherwise they could risk losing those goods and any value that's in those goods for the company and the creditors. Otherwise, Revenue and Customs would take possession of those goods and sell them. So they really must talk to an insolvency practitioner very quickly if that happens.
Richard, a Creditors Voluntary Liquidation, a CVL, how much will it cost?
Well, that's a question we quite often get asked by directors. And really, we can't really answer that question until we've got a much deeper understanding of the case. So we have to ask the directors about what sort of assets there are there, the employees, how many creditors there are, if are there any legal disputes ongoing, are there any other matters that they ought to bring to our attention. And I think before we can actually formulate what the cost might be, we'd normally have a no obligation meeting with them and really say, well, this is really what it would cost to get up to a creditor's meeting stage, and then depending on what happens then, it's really based on time costs after that, but that's very difficult to put down an exact figure.
With administration, what's the difference between a pre-pack administration and administrations?
Yes, well, again, this is another question we do get asked quite often. Pre-pack administration is really where the companies are insolvent and there's an ongoing business there, and the business can't cease trading, and it has to have someone else to take it over immediately without it being closed down, and that's where a pre-pack administration can really be beneficial. It enables the continuity of the business. 1 second it could be trading as the old company, a sale agreement signed, and then the new company takes over the assets and the old company is allowed to die. In an administration situation, there is an ongoing business, a viable business there, but it probably will take some time for that to be sold, and there needs to be a trading period involved. And an administrator would then develop a marketing strategy, a trading strategy, and ultimately sell the business perhaps 3 or 4 weeks after administration. But the costs of both are roughly the same. With the pre-pack, the costs are built in before the appointment, and normal administration, the costs are built in mainly after the appointment.
Company voluntary arrangements. Why go into a company voluntary arrangement?
Well, in this sort of situation, the directors don't want to lose control of the business, and if they can see a way out of the position they're in at the moment, a CVA, or Company Voluntary Arrangement, it gives them a breathing space to recover. And that breathing space is actually can be up to 3 to 5 years, and they pay so much back to what they call the supervisor over that period, and the end result is that creditors should get anything between normally 30p and 50p in the pound back. So the directors are in control. We're not running the company, we're just a tool really to enable creditors to get a payment back.
Richard, can you give me some examples of actual companies that you've helped and the way that has happened?
Well, yes, I mean, we've dealt with a printing company recently. It's been trading for over 20 years, and with the recession and everything going on at the moment, they found they couldn't continue to trade, and there were many employees had got 20 years service. The directors had reached retirement age, and they couldn't afford the redundancy costs, and the result of that was that the company did go into liquidation. We did sell the plant and equipment, but I think the main thing from the employees' perspective was that they got on average around about £15,000 each from the insolvency service, which the directors couldn't afford to pay themselves. So that was a plus there, and resulting sale of the plant and equipment really meant that the bank got paid as well. Another example is a window company, and in this case they'd suffered the effects of the recession. They were doing contracts for schools replacing windows, and they couldn't sort of survive with the number of staff that they'd got. So we looked and realised they'd got a good business plan going forward, but they needed to cut the number of staff. And what happened there is we recommended a company voluntary arrangement. We got some forecasts drawn up for the company, and the result of that was that at a creditors meeting, the creditors approved these proposals for the company going forward. And it did mean that the company didn't have to pay the redundancy costs for the employees, because those were met from the government, who then became creditors of the company and received dividend payments over a 5-year period. So that's really a success story of a company in a voluntary arrangement taking their business forward with the directors still in control. Another example was a haulage company that we dealt with last year, and that was where the revenue had actually got a distraint over the company's trailers and trucks for around about £200,000, and they hadn't got the money or wherewithal to pay that. So they came to us, we had a meeting with them, and we recommended that they go down the pre-pack administration route, because they realised that they had lost a lot of contracts over the past 6 months, but they had got a core business going forward with customers that still use their services. So we arranged a sale and pre-pack sale to another company, which was actually owned by the directors. We got a valuer in to value the trucks and trailers. Talked to the Revenue and Customs, and they said, yes, we'll go along with that. And the result was that this company is continuing to trade now in the new format, and saved probably 40 out of the 80 jobs as a result of that. And that was an example using a pre-pack administration route.
Richard, tell me about your team.
Yes, well, on the corporate insolvency side, I've got 7 team members. They've got over 60 years experience themselves, and then with myself and Tim, that makes us over 100 years, which is quite a lot of insolvency experience, and it deals with all corporate insolvencies, company voluntary arrangements, administrations, liquidations, so we really cover the whole sphere.
Tell me about your background, Richard. How did you get to where you are now?
Yeah, well, I've started in insolvency in one of the big 4 firms in Birmingham, and I've had 19 years experience there, and I've got another 8 years experience with Griffin and King now, and I much prefer the smaller niche firm, and you actually deal with real people and trying to understand their problems and help them, and I think that's really beneficial.